Right, so what is the 2012-13 budget about? It's about a lot of things. And a week after it's happened, we are still trying to work it all out. And I think that this is the biggest opportunity for financial planning that we have seen in years. The minister should just have announced it. I've given you 8 to 10 billion rand extra a year subsidy into retirement planning. But nobody seems to understand that. So what I've done is I've done a lecture here entitled 10 Lessons in Financial Planning for 2012-13. And you're going to see how I'm going to move together the politics, the tax, all the lifestyle issues, and everything else together. So we'll put all of that together and see how it goes. We were expecting that this year's budget would be all about the global economic storm. And they'd be making all sorts of excuses and all the rest of it. And the Minister of Finance took a about turn on that. He said, well, we'll leave Greece to Greece and to France and to Germany. They can go and make their issues. We have got a 1 trillion rand budget in South Africa, which is pretty small if you think that it's only looking after 50 million people, when the bailout for Greece last week was 1.3 trillion rand to look after 11 million people. If they were rewriting the budget today, the Bible today, they would say, "Blessed are the Greeks, for they shall borrow the earth." It's absolutely incredible what's happened, and that we in South Africa have managed to be good and frugal with all our problems and to keep it all going. So we can leave Greece to Sarkozy and Merkel with their favorite new song, Absorb the Greeks, and we can get on with the rest of it and see what it's all about. Right, let's do it in the Jacob Zuma era. So we get to May 2009, Mbeki departs, and Zuma comes in. And the great thing about it is that he put the top finance man in South Africa, Jacob Zuma. Jacob Zuma appointed Prof as the top finance guy. Almost immediately, growth rates recovered, and by the time we get to Gordon's first budget speech, we get a position that he's saying, well, let's leave this thing. Maybe it will fix itself. And through 2010, that certainly continued, and part of 2011. The problem is that in late 2011, growth rates started to fall off. And that has an enormous implication for everybody. But I don't think people understand the basic reactions and things that go with this. So there's your global credit crunch in red. We go to the recovery in 2010, beginning of 2011, and it all looks okay. So a year ago in the budget speech, Prof Gordon said that South Africa will grow 3.2%, and everybody believed him, because in the first quarter of 2011, we did 4%. But then it fell off, and by October last year, we are down to 3%. Now we carry on from that position. And we say, well, what will the growth rates be going forward? That's all history now. Where is the South African growth rate going? Jill Marcus in budget, in her last Reserve Bank speech in beginning of February, said 2.8%. The IMF said that's too much, 2.5. And in the budget, Prof Gordon said, I'll split the difference and I'll make it 2.7. But importantly, saying recovering by 2014 to 4%. But that's a story for another day. What we've got to say is, in your national numbers, are we running up a deficit? What is this issue of deficits? And the deficits that you see there were established a year ago at 5% of GDP dropping to 3% of GDP. They've readjusted those figures very, very slightly in October last year. And then in the budget this year, they clean up further. And what's important is that they show that the current year deficit will be 4.6% of GDP. And that will stay at that level, but slowly come down. And by 2014, we will go back into a 3.9% of GDP rate. And by 2015, we'll be in the low threes. Why are they so obsessed with this? And what is the impact? It's a huge impact on all South Africans. Because simple economic formula, growth rate goes down equals tax receipts drop. When tax receipts drop, deficits go up. When deficits go up, the international rating agencies give you a downgrade, and the result of a downgrade is that your risk profile goes up and your interest rate goes up. And that is the one thing that they are not going to let happen in the new South Africa, interest rate increases, because it will cause total economic chaos. We've got enough of a problem with rising fuel prices, rising energy prices, rising everything else. We can't go and add on to that interest. So the flat rate of interest that we are seeing at the moment and have seen for the last year, which is super if you're borrowing, is going to stay there. But on the other side of the coin, if you're trying to save, that flat rate of interest is going to continue. And it's very worrying. Now, in South Africa, our total debt to GDP ratio is nothing like what we've got in the rest of the world. Greece are at 166% of GDP to come down to 120% of GDP by 2020, even with an austerity package. South Africa is looking at 37 to 45% over the next couple of years. Keeping it low so that you keep the international rating agencies off your back. Investment lesson 1. Interest rates are going to remain low. Now that's great if you're borrowing, but it's not great if you're saving. South Africa can't afford to increase its interest rates. We're going to stay where we are with a return on a deposit being around 6%, and inflation has gone up to 6%. So pre-tax interest equals inflation rate, post-tax interest is looking below the inflation rate, and you're going back if you backwards if you save in a bank account. That's lesson 1. Lesson 2 concerns taxes. Now, a year ago, with the consumer going to sleep, they recognized that tax collections are starting to fall off. And in the budget, you see what the final outcome is going to be. They're saying VAT for this year will be 10 billion short. Individuals tax another 3, but then comes an interesting sign that we've got to look at. Transfer duty receipts are falling away. The residential property market is in tatters, and we've got to come back to what that means in financial planning in a moment. Then, they've got the money back, or most of it, because corporate tax collections will increase. We'll smoke too much, drink too much, and leave the lights on, so we'll pay extra taxes there. And finally, we'll buy too many cars, so carbon taxes have increased. We start to see that emerging into our thing. I'll put this all together in what it means in a moment. So where you are is on your major taxes in South Africa. You've got a position that we are only 4 billion short on the total budget of 742 billion tax collections. Fantastic, brilliant, better than any country in the world probably. Personal tax collections are on target. Corporate tax collections were slightly up and VAT was slightly down. That's how they balanced the budget. The rest of them are pretty small and insignificant. Estate duty wouldn't even affect that pie chart. Then we go. And we say, the problem is the tax load. And this is what they've identified in the budget. Individuals are paying too much, 34% of the total pie. Companies are paying far less, at 21%, when they should be more or less equivalent to individuals' tax collections. And VAT collections are also under pressure. And that's what they're trying to correct. They're saying companies have had it good since 2006, when they started dropping the corporate tax rate and moving towards dividend tax. Their tax collections have fallen off. It's time to get something back there. So their game plan for this year is simply to say, hopefully company tax collections will increase as we recover. Then, STC collections will stay the same even if you call it dividend tax, because we're going to raise the dividend tax rate from 10% STC to 15% dividend tax. They had to do that, otherwise they would have a hole in the bucket. Then we'll go to the consumer, and we'll beat them up a bit on fuel and on sin taxes and electricity, etc. VAT will increase with your inflation, but not by a huge amount. And then we'll go back to the personal tax, and we'll get an extra 33 billion rand from the individual taxpayer. We'll have a look at how that works in a moment. So it really works in South Africa on 3 big taxes. Personal tax, holding the ship steady, VAT recovering, and now they're trying to reverse the trend on corporate tax payments. So that's quite a change. And then we go to the individual taxpayer and we say, well, who pays that individual tax? And they say there are 4 million taxpayers. Yes, there are. But the first 800,000 or 19% of taxpayers are below tax threshold. They don't pay anything. Then there's a whole chunk of them, 25% of the taxpayers, another million, that only pay 4% of the tax, and they're in the bottom rungs. The majority of the tax is paid by two groups of taxpayers. 120,000 to 400,000, they pay 42% of the taxes. And then a staggering, a mere 378,000 taxpayers, or 9% of the tax population, or less than 1% of the total population, pays 54% of individuals' tax. And that's where your clients are sitting. And that's why you've got to say, hey, wait a minute, there's a big lesson to be learned here. You are tax targeted if you go above 400,000. Now, today is the great day of provisional taxes due. Today's SARS's payday, okay? They get over 50% of their provisional tax arrives either today, 29 February, or on 31 March. That's due to the acceleration of the second provisional tax payment if your income is over R1 million. Please, if you haven't heard about that today and your income is over R1 million, you better get out of this lecture and very quickly go and find a tax consultant, because otherwise you're going to run up a penalty. But then on PAYE, they are recovering most of the individual's tax from employment through the PAYE system. Really, it is only interest income and investment income which is exempt from tax, and what you see there is them getting the money quicker and closing down the loopholes, because they're making the employer deduct the tax, take the tax risk if there's a stuff up, and then the employee can try and claim it back on his tax return if he can, and that's very difficult. But overall, we see this trend of corporate tax lagging behind individuals' tax. And that's what they're trying to correct this year. They're trying to do a better deal for the individual taxpayer. So what they do is they take the tax tables, and now watch what they do in Parliament. They say, we're giving you money back. So Trevor Manuel said, 2009, I gave 13 back. Then Prof Gordon runs with his figures that he says he gives back every year, including 9.5 billion rand this year. And you say, gee, is that a better deal for the taxpayer? And the answer is, but just now we saw that the national budget shows that they'll get an extra 33 billion rand from the taxpayer this year. That is only the inflationary change that they've got on those figures there. It's not the overall change. So what they do in the inflationary change on the tax tables is that they up the bottom rung. Then they adjust the middle. Then they adjust the top run. Up to 617,000 rands is your super tax level now. But watch that, because whether you're paying 40% or 38%, it still hurts. And you're at 38% at 455,000, and at 35% at 325,000. It rises quite quickly once you get into the tax tables. Then they fiddle with the rebates. Now, we've now got 3 rebates to confuse everybody, and 3 tax thresholds. So below 65, you won't pay tax until you've earned 63,000. Above 65, it's either 99,000, or if you are over 75 years old, it's now 110,000 tax threshold. Very nice. But what does that mean? It means there's a fundamental difference. When you are employed, you're at the top end of the tax tables. You're paying in 35, 40% marginal rate. When you retire, you move up the tax bracket into the poorest section. So, for in the example of a retirement annuity, you get a 40% tax deduction now, but when the income comes back, you're not going to have a 40% tax rate. More about that later. It's an important principle. So there's a lot to be read into the tax tables, and I'm going to start unpacking that as we go along. We'll also see the medical credit come in from the 1st of March. This is not an additional form of taxation. This is to distribute it. We used to have a medical aid exemption. Now they say we're going to give you a medical rebate. It will be the same for all taxpayers. They've pushed it up from the 216 rand proposed last year to 230 rand per month proposed this year. Now, so that's an extra 14 rand. It'll pay for half a Viagra tablet. Okay, it's not a lot of money. And then for the subsequent members, numbers 3 and above, they've pushed the monthly rebate up from 144 to 154. It'll buy you about 6 Bernardos. All right? So that helps a little bit. And then on additional expenditure, they are saying it will also qualify for a rebate, which is calculated, again, using the old formula. If your medical expenses exceed 7.5% of taxable income, you may claim, but the effective tax rate will be 25%, not 40%, as you had in the past. And the over 65s will join into that regime from 2014. This is not to pay for national health. This is simply a reallocation of the medical money to make sure that all taxpayers benefit the same. If you're talking national health, you're talking a budget of 125 billion rands a year, which is more than double the current medical budget. They haven't got there yet. When that comes along, there's going to have to be a big debate about who's going to pay. How much will come off your salary? How much will come from an increase in the VAT rate? That sort of thing. But that's still a long way off. It's very encouraging in the budget that the minister has said, I want the hospitals fixed before we go to NHI. So I think NHI is a long-term project, and it's not with us yet. The annual interest exemption has been left at the same level. And that's a good thing, because every year people look at that exemption and say, I must produce interest. And you say, well, why do you want to say hell-bent on producing interest? Because it's tax-free. But if it's 6% and it's tax-free, you're not going anywhere. So they're now saying, well, let's have a re-look on this. They're having a rethink. They'll leave this unchanged for the next while until they bring in a general savings exemption from 2014. And what that's going to do is that's going to give everybody 30,000 Rand exempt income per year. And it's going to be applied across the board, not only on interest. So that's a much fairer deal, but it's still a way off. It will be capped at 500,000 Rands tax-free income in a lifetime, and we'll have to see where it goes. There will also be a tax-preferred savings scheme. We don't have the detail on that. That's still to come. But the idea of some sort of government agency or savings scheme where costs are lower and there's a tax preference, we'll have to see what their paper says about it. Lesson 2. Tax rates are increasing. There is simply no point of producing more and more income if it is chasing you higher and higher up the tax scales. Tax management in what you are doing is absolutely critical. Now, if you were lecturing this at university, you'd say, stay awake now, because this is where it gets very important. What we've got to look at is the change in the different tax rates and the different classes of income as they apply to the major groups of taxpayers. So it starts off with the change from STC, when companies distribute dividends, to dividend tax. That happens on the 1st of April, and what it will do is it will increase the tax on a corporate distribution from 7.2% now to 9.39 out of 100, regardless of whether there's the 15% rate. Now, you've got to take that and say, what does it mean to the investor? And the answer to that is that the inherent corporate rate of tax on a distributed revenue profit is now 37.39%, almost as much as the individual taxpayer. Lesson 3, dividend tax has increased, but it's hardly going to affect you, because you are talking about an extra 5% dividend tax on a dividend yield of 3%. So if you put the two together, it's percent. It's a tiny difference. You must remember, in the emphasis of tax, dividend tax is less than 3% of total tax collections. It's a very small amount that they're looking at. And the increase is probably not very much compared to where you were, because remember, in the old days you were paying STC on distributions to retirement funds, and that's going to stop with effect from the 1st of April. So there's no need to shy away from equities investments simply because we've got an imposition of a higher dividend tax rate. You're not going to feel that one.